No, this is fantastic. And I love investing. That's what I do is I'm a real estate investor. And as I do things in my business, I want to share it with you guys. And so I was talking with Mike. Mike's going to be coming out and being a part of Rubicon this year. And he and I were talking, and I was thinking everything that he's talking about in becoming a bank for ourselves and generational wealth is just fantastic. And I thought, you know what, I need to do this myself. And then I thought, well, how much better would it be if I just share it with everybody else? So with that, Mike is here in Phoenix area with me. It's going to be fun to have him. Oh, I see on the chat, Juan said he's in Boston. Michael McGill is in Coeur d'Alene. Oh, my friend, I have a good friend that's in Coeur d'Alene. He loves Coeur d'Alene, loves it up there. I bet it's beautiful up there. But Mike is going to be sharing about how Pittsburgh, Elizabeth, sorry, I'll just keep every once in a while somebody pops on, say where they're from, go ahead and do that in the chat. But then if you guys have questions, put them in the chat, because Mike is going to be doing just sharing what, his background, what he does with his investing, and then how we can do this same thing as well. But write all your questions in the chat, so then I will be able to watch them and make sure we get the questions answered. Then I will also have questions for him as well. But what this really is just a big learning thing. Just really big learning on how we can do more so that we can help us invest. So with that, Mike Bargetto, go ahead and take over, man.
Yeah, Dustin, thanks so much for having me tonight. You guys, great to meet you. I'm honored to be presenting in front of you this evening. We're hopping into my favorite discussion, how to reach or maintain financial freedom. And I feel that if you do this with intention, reaching financial freedom can be done in less than 10 years. Right now, I'm living my second career. My first career was spent in the fire service. I spent 15 years fighting fire for the great state of California. And about halfway through my career, someone gave me a copy of that little purple book that I'm sure many of you guys have read, Rich Dad, Poor Dad. And I had it on shift with me. We ended up getting punched out on a strike team from Southern California up to Northern California to go fight a wildland fire. And I was the backseat firefighter on that shift. And during that 13-hour drive, I got through that entire book while also maintaining my obligations to my job, right? But as I'm reading that, I'm going, man, there's people out there who are not spending these sort of hours working for the man or working for someone else, doing things that they're not passionate about. And a few years later, after reading Rich Dad, I ended up leaving the fire service. I left the fire service in 2017. Not because we had enough cash flow. To be fully transparent, we only had one rental property when I left the fire department, but we had just sold our primary residence and we were sitting on quite a bit of cash from the gains of that property. And I just took that as my runway to become a full-time real estate investor. In 2017, we had one rental property. 2018, we had 3. 2019, we had 27. And 2020, we had 38. It was during that 3 or 4 year period where I learned about whole life insurance, which is what we're going to dig into tonight. Infinite banking, we call it becoming your own bank. We put the power or the control in our hands, and we were able to massively accelerate our portfolio. Now, the cool thing about whole life is I started studying it, and we're going to dive into some numbers tonight and show you how to utilize one of these policies. But the cool thing about whole life is I started comparing it to what we had been investing in our whole working lives. For my wife, it was her 401k. For me, it was my pension. And I started looking at the numbers and I realized that a whole life policy wasn't all that off from a 401k. Of course, we can't predict the future performance of the stock market, right? But the historicals were telling me that whole life insurance performed very, very similarly to a 401k, but there was something that the 401k didn't offer. And that was liquidity with my dollars. My capital was, or my wife's capital was tied up in her 401k. Mine was tied up in the pension. Whole life insurance put the control back in our hands. So I'm not recommending that anyone do this. I never recommend that our clients do this. But what we did was, because we saw the power of whole life insurance, we ended up cashing out all of our retirement accounts, including the pension. And if anyone understands CalPERS retirement, it's touted as the top retirement pension fund in the world. I cashed out after I left, and that allowed us to put the money inside of our whole life policies, leverage against those policies, and go out and buy assets. And since leaving the fire service in 2017, we've done over 50 deals, be it our buy and hold portfolio or flipping. And it all came back to understanding how to utilize and how to access your own capital, our own capital. Questions so far, Dustin?
None at all. Keep going, buddy.
Okay. So it sounds like some people here are already familiar with whole life. Whole life is a permanent life insurance product. It's not tied to the stock market. We put money inside of whole life policies through annual premiums or the initial dump in when you go in force on a policy. And those premiums convert to cash value. They buy the death benefit. It's a permanent death benefit that you get to utilize regardless of when you pass away, which is a stark difference from term insurance. Most people pass away after the term period, which is what makes term so affordable. So whole life provides protection for the family, but it also provides a growing cash value account that you get to leverage against to, in this case, go out and buy real estate assets. So if you don't have questions, Dustin, I thought I would share my screen and just show an illustration.
Yep.
And I'm not monitoring chat, so if you're on that.
Totally have that taken care of.
Okay.
Yeah. So if you have questions, write them in the chat. We'll definitely make sure we ask him of Mike when he's all done presenting everything.
So here we have a 30-year-old person, and he's putting in $30,000 in annual premium. This dollar can change. It can go up. It can go down. I used 30,000 for this example. We put 30,000 into this policy right here. And we're going to pay for the cost of insurance up front with whole life. Okay, so immediately we have $24,550 in available cash value. The cost that year, the first year, was $5,450. Cost goes down year over year. Year two, it's $3,088, negative $260. In year four, we have our first positive year of $3,729. So you put in 30,000, your account grows by 33,729. Each and every year moving forward, that increase continues to build. And so if we come down here to year 10, we put in 30,000 times 10 is 300,000. We have a total cash value of 360,000. We started with a death benefit of just under $1 million. And after 10 years, we have almost $2 million in death benefit. And so when I saw this, I realized that I didn't have to necessarily put every dollar inside of my life insurance policy, but the dollars that I did put inside of whole life would allow me to acquire more assets over time. You'll see after 10 years, we put in 300,000 and we have 60,000 more, almost $61,000 more than what we put in. Now, there's a very unique strategy that goes with whole life. Anytime I have an opportunity that crosses my desk that I want to partake in, I could take a distribution from my cash value. Those dollars are mine. I can use them. But if I debit from this account, let's say we're in year 10 and I want to pull 60,000 out of this account, I will have 300,000 and some change left over. The cool thing about whole life is we're allowed to leverage against our cash value. If anyone here has had a HELOC against their primary residence, a whole life policy is very similar. Instead of taking the doors off of our houses or breaking into the walls, there's no money in there. We go to the bank and they give us their money that we get to go deploy into investments. It's the same thing with insurance. The insurance company gives us their money, and that allows this compounding effect to continue to compound until the last day that you're on this earth. Questions so far? Anyone from the group, feel free to chime in, ask questions. If you don't want to put them in chat, you can just ask.
Yeah, so a couple of questions. NFL said, heard of whole life, that whole life, when you pass away, your family has to choose between cash and the insurance part. What can you say about that?
Yeah, so the cash value is there. Think of it as you using the death benefit or a portion of the death benefit while you're still living. So in year 10, we have almost 2 million in death benefit. The insurance company is going to allow you to use 360,000 and you only put 300 in. So at the time of passing, let's say your spouse is your beneficiary, the cash value goes away. That was a living benefit. Your spouse gets the death benefit, which is income tax free at 1.98 million. Great question.
And another question is, so what's the difference between this and a self-directed IRA? I could definitely answer that. So this is whole life insurance, and a self-directed IRA would be if you had an IRA from your company or from, the company that you work for, or a 401k, a self-directed 401k. That's your retirement money that you've been saving every single paycheck, putting it in, and then you could then use that, which we do that here at Master Passive Income. We invest with our IRA, self-directed IRAs, or solo 401ks, because we can invest that, keep it in that, a retirement account, invest, and then pay it back. That's one thing. This is a wholly different thing, which is the whole term life insurance, being able to utilize that for all the benefit. And so when Mike already walked me through this, and I was looking, I was like, okay, so, obviously $30,000 is a good amount of money, but obviously they can adjust that. But I'm already getting life insurance for my family, and I get the total death benefit, which is great for my family. But I'm looking at what I can use this for my real estate investing. And that was how much we can borrow from that. So a question that I had, and Mike, I'll ask you. So a question I had was, when I'm going to borrow money, at what point would it be wise? Let's say I know I'm going to use money either for a down payment, or let's say I might be able to buy with a house for, let's say, $60,000, $70,000 cash, like in the Midwest or something. At what point would I be able to start borrowing? Would it be wise to start borrowing? And basically, because if we're going to do that, we get a death benefit, which is great, but we also want to be able to borrow from it as well. What do you think, Mike?
Yeah. So this tool is great if you're willing to use the living benefits, right? I mean, the death benefit's fantastic because it grows each and every year. So it helps fight against the inflation. But we're actually driving, and if you guys go further through this with us, we'll break a policy down. But what we're doing when we're overfunding these policies is we're driving down the death benefit as much as we legally can, which is allowing us to put as much cash value in the policy early on. And you have access to these funds within the first 30 days of going in force on a policy. So the rule of thumb, guys, is if you're investing in a piece of real estate, for example, and you have cash outside of a whole life policy, use that cash first, because right now that cash is not doing you a whole lot sitting in a checking or savings account. It's also not going to cost you to borrow it, because you're not going to borrow it. You just use it. So deploy all of your cash first. Next, we come to our whole life policy and we borrow against our cash value to acquire that asset. Now, it goes a step further. When we acquire an asset that hopefully throws off cash flow, that's what most of us are doing with real estate. When that cash flow comes into our lives and it hits our checking account, the velocity on those dollars hits zero, because most of us are earning close to 0% in our checking and savings. Well, if we have an outstanding policy loan in our life insurance policy, now we have a home for those cash flow dollars. We can shift them from our bank account and put them into the whole life policy to begin paying down that policy loan, which increases the efficiency. So this was compared to a retirement account. There's a place for self-directed retirement accounts. Absolutely. The great thing about whole life is it allows you to invest outside of retirement accounts. And I care less about the tax benefits in those said retirement accounts because there's so many tax benefits inside of real estate. But owning real estate outside of the retirement accounts allows me to utilize the cash flow that affects my life positively today. I get to change my lifestyle today, or I get to make financial decisions that impact my life in other ways today. And that's why I like investing outside of retirement accounts.
I think that's great too. Well, everybody, I've always mentioned what I did with my retirement account. I make so much more money investing in my own property. So I literally cashed it all out, paid the penalty, and made so much more money because I'm an investor. That's what I do. I believe retirement accounts are great, but at the same time, they make other people rich. Just use that money yourself, in my opinion, so you can make yourself rich. Another question is this the same as universal life insurance?
No, so it's far different. So whole life is in the same category in regards to it being a permanent life insurance policy. IUL and whole life are the same in that way. IUL is tied to an index. It's indexed universal life. And we can talk about the stock market in a different conversation, but I don't want the foundation of my financial life tied to any index. I want it completely outside of the stock market. And that's what whole life provides.
So, sorry, I'm going to add to that.
Please do.
So I had a universal life policy, and I actually put into it monthly for years. And that's how I took out and put towards my investments. So I guess just trying to understand the difference, because I too pay that back, but you know, it's like $20 a month or something. It's nothing compared to what you would on a regular interest. So I guess what's the value of whole life versus pros and cons on whole life and universal index?
So the rate of return here that you see on this illustration
Uh-huh.
is dependent on the guaranteed rate of return offered by the insurance company and the dividend rate, which you'll see in this column here. The dividend is not guaranteed, though the mutual carriers that we work with have never missed a dividend payment, which in most cases is well over 150 years. The dividend can change, it can go up or down, but it's generally going to be there. It has been every year. This is your combined interest rate, or your combined, your total rate of return, guaranteed rate, and your dividend rate. This is
Okay.
how your policy is going to perform. Most index universal life illustrations, when they're sold, are going to show much higher numbers, but they never perform as illustrated. And the
So
reason why is because
year over year, it's performing those rates.
correct. Yeah, this is that year's performance. The costs associated with IULs or universal life tend to go up over time, whereas with whole life insurance, the cost of insurance goes down over time.
What's the minimum premium? Like, can you explain that with the death benefits?
So the number is all dependent on your situation. 30K is not going to fit for everyone. For some people, it's 150K a year. For some people, it's 10K a year.
But
So-
what would 10K get you versus 30? Because 30 gets you $1 million, right? Is that what you're saying? $1 million
Yeah.
death benefits?
Yeah, so when it comes to life insurance, you have to qualify based on your health and wealth. And
Yeah.
so the older you are, the less attractive a policy is going to be. And there's
Oh, I'm in trouble.
several health ratings. And so it would be hard to say what the actual death benefit would be for a different amount.
Okay.
Does that make sense?
Yes, it does. Thank you.
Great questions.
Another question somebody had, Juan said, he's heard of people using a trust to put their life insurance in. What are your thoughts?
Yeah, it's a great concept. People do it. Most of the policies that we sell do not go into trust. It stays in the person's name. Whole life insurance is a private contract. So whether it's in a trust or not, depending on what state you live in, and I put a little asterisk there for those in California, it's not as beneficial, but you're probably not surprised. There is a level of asset protection with holding a whole life policy in your personal name, because again, it's a private contract. The downside to putting policies inside of a trust is it can be more difficult to access the cash value, which is a huge benefit, obviously, to these policies.
Well, that's why it seems like I want to do it. I want to access that stuff. And
Yeah,
Evan asked,
100%.
what happens after 20 years, the total premium? What happens to that?
Yep. So I only have the supplemental ledger up. I don't have the other ledgers up. But remember a minute ago where I said we're driving down that death benefit as much as we can to increase the cash value as much as possible? Think of that a $30,000 annual premium in two categories. You have your base premium and your PUAs or paid up additions. Your base will buy the death benefit and the PUAs buy the cash value. So we are driving that base premium down as much as we can. And that's actually that $4,746 you see starting in year 21. You're paying that $4,746 every year, but the PUAs run years 1 through 20. And then by year 21, if you want to continue paying the base, the policy is so efficient at that point that the base has caught up and it is contributing to the cash value. And so another thing to take into account here, guys, is the commitment on these is minimal. There's a lot of flexibility on the side of the policy owner that the insurance company has to abide by. The cash value can be utilized tax-free so long as you take out policy loans if you fund the policies for at least 8 years. So after 8 years, you can pay up the policy. It's called an RPU, reduced paid up. You can pay up the policy, which means we're going to turn off all future premium payments, but you get to continue utilizing the growing cash value and growing death benefit. You also have the flexibility of only paying the base if you ever come into a hard year. So if you have a $30,000 premium and you don't have 30,000, you could in theory take a policy loan. We've done this in the past. We take a policy loan out of your, say, 360 to pay year 11's $30,000 annual premium. Or you could just bypass the PUAs that year and just pay the base, which is 47, 46.
And a question came from Ryan, still not understanding the process. Why invest $30,000 to only get $25,000 out? 5% returns doesn't seem that great. And was asking basically, give me a play-by-play. Like, what am I missing on this?
Yeah, so if we isolate just that, then it's not that attractive. But neither is real estate. If I go buy a $100,000 asset in the Midwest and it only brings in $10,000 a year, it's not super attractive. But you have to look at the entire picture. You're getting those 4 pillars of real estate if you're leveraging the property. And over time, that's going to help you reach or maintain financial freedom. So if we isolate the first year or even the first 5 years, it's not that attractive. But if we have the mindset of, hey, we're going to get a policy and we're going to own this policy for the rest of our lives, instead of looking at year 1, let's go look at year 20. We've put in 570,000 and we have 906 in cash value. So absolutely, there's a negative arbitrage in the first 3 years in this policy, but it's the long-term play.
And definitely, I found that for me, when you get insurance, it's for literally long term. You're hoping you're not going to need it, but it's there when you have it. But this, let's say you're able, I mean, shoot, at year 10, your total cash value is obviously more than you put in, which is great. But then it seems like it exponentially grows quickly after that. And then year 21, I was like, wow, I literally decrease how much I put in and it continually grows beyond that. Now, Mike, talk to me about like our children being able to, like, is this something we can pass to our children? How can they utilize it and all that sort of stuff?
Yeah, so most people have their children be the secondary beneficiary. So they're a part of the conversation in that way. On top of that, a lot of our clients are now getting policies on their kids, because what we're doing here is we're locking in insurability for the rest of the person's life. So if you get this policy at age 30, age doesn't matter, but in this case, age 30, and you have a heart attack at age 40, it doesn't matter. They're not going to take this policy away from you. So when it comes to kids, the policies are generally not as large, right? Because they can't get it as much insurance, nor do you want to put in a premium this size. But with any premium that you're paying for your children's policy, what you're doing is you're locking in guaranteed insurability for the rest of your kids' lives. So I think that's a secondary play. The primary play is to protect the family by insuring the income earners with this death benefit. But if there's enough left over, and maybe it's in a few years, we then start talking about possibly getting coverage on the children as well.
Got it. And so NFL was stating, actually, NFL, do you want to jump on and maybe ask a little question, like more specifically? Because she was saying that it's still hard to understand. And obviously, I'm not a numbers person, so this isn't the easiest thing. I have my wife. She's amazing. She is the math person in the family. But NFL, do you want to ask your question or see if that would help you?
Hi, good evening, guys. So to my extent, it's I think like this is the way I see it is this is like more for a person that definitely is looking to invest in real estate, right? Because if I'm looking to be able to protect my family from debt, if I take money out from this policy that I have, then the debt benefit is going to go all the way down, right? Like as money I take, the debt benefit is going down. Is that how it works? Because that's what I'm like understanding, and I don't know if I'm wrong. So.
Yeah, that's a great question. So let me ask you this. Are you a real estate investor or wanting to get into real estate?
Want to get into, and as of now, I have my term life insurance and then I do my Roth IRA. So that's how I have it planned out.
Okay, great. So remember in the beginning of my personal story where I was talking about how access to that capital when I first left the fire service allowed me, it gave me permission to leave my W-2 and go do what I wanted to do next, invest in real estate and be a full-time investor. having access to capital is key if you're in this space. Even if you're not in this space, having access to capital is huge. For the last 10 to 15 years, people have relied on HELOCs as their emergency fund or personal line of credit to go invest in assets. Those days are shifting. We are seeing runs on banks. Banks are tightening their lending standards. So having access to capital is becoming much more difficult. If you're in this space or getting into this space, always having access to money smooths out all of the rough patches of your investing career. We call it the stack at Axiom Wealth, where the stack is a stack of capital. First, it's your personal reserve fund, 6 to 12 months of your personal expenses. Then it's your business or real estate reserve fund. And then on top of that is your opportunity fund. If you have no capital, you're not going to be able to weather any storm, nor are you going to be able to partake in a whole lot of deals. So if we can shift our strategy from storing cash inside of a bank, a typical checking or savings account, and shift it into a whole life policy, that capital that would otherwise be sitting on the sidelines doing nothing other than providing security for us, it can now be working for us 24/7, and it's going to provide that guaranteed death benefit. Did that answer your question?
So to answer my question, would it be, when I take out the money, would my debt benefit be going down?
So again, so it's a great question. So if you're taking, let's say this is your policy here, and these are your numbers for cash value. So you have 151,000 in year 5. You borrow against that and you go buy an asset. If you never pay it back, yes, when you pass away, all the policy loans will be deducted from your death benefit. But your job as an investor is to replenish that capital that you spent, because you're going to go buy the next deal. Or again, the stack, you have to have the reserve you have to have the reserve funds in place so you can weather those storms. So the goal here with whole life is not to just continuously borrow against the cash value and never pay it back. It's to send your cash flow or savings from your business or W-2 and put it back into the policy. And we're just recycling money in and out of these policies throughout our investing careers.
And what I'm also seeing too, NFL, at least Mike, this is what I'm seeing. If I borrow $151,000 out at year 5, and then the total death benefit is $1.4 million, it's just deducting that the 151,000 out of the 1.4 million. Is that correct? And they still get the balance of that. That's a lot of money still. Yeah. Yeah.
So let's use bigger numbers. Let's go down to age or year 20. Let's say we max out our policy loans and we're at 983,000. We have over 3 million in death benefit. Now, that's not a bad thing at all unless you took that 983 and spent it on liabilities. But as a sound real estate investor, you probably took that 983 and bought assets with it. So instead of your beneficiary getting almost $3.2 million in death benefit, they're going to get a little over 2 million plus all of the assets that were acquired with that 983.
Yeah, I love that. So NFL, does that help? Because there was a bunch of other questions, but I don't want to leave you hanging.
Yes, it does help. Thanks.
Good. That's great. So Evan and I want to answer your question, and Scott, I want you to chime in if you don't mind. So Evan was asking, and I'll tell you what I would do. And if I were telling this to my kids or anybody, it says, so if you were to go back with your first dollars, would you put them into a whole life insurance policy, or would you buy your first property? Me personally, buy my first property. That's the number one thing. We're investors. We make money. We make a minimum of $250 a month in passive income right away. And then we can keep making more money, snowball that into the next property and the next property. And then with that, you can also then start buying, because we just need income, in my opinion. I wanted income from the very beginning. Get properties coming in. That's my suggestion. At least that's what I would do. And then I think, so Scott, if you're still on here, you said that you've also used this in the past. Do you mind sharing a little bit about your experience using it? Scott's still here. Oh, Scott, come on. Are you there? I see you're on, but I don't see you.
Yeah, I'm here. Sorry, I'm here.
There you go.
I'm here.
You mind sharing,
Sorry
Scott?
about that. Yeah, sure. If you set these policies up right, and I think that's the key, is knowing getting an agent that knows how to do them with this in mind. You know, I just bought a house last year. You know what the down payment was? I put that money, basically, I took it from a retirement account. I put it into the whole life policy. I took it out loan on the whole life policy, and I put a down payment on the house for it. And now that's cash flowing nicely. So it's just easy. You know, if it's set up right, it's easy. You've got flexibility. You can put in, you know, as much or down to the minimum premium that you need to, pay every year. You can set it up that premium is only due for a certain number of years and just keep recycling it. And then eventually you can live off the dividends of the policy itself and don't have to, and it'll pay its premium, and you can take some money out of it, as you go forward. So that I haven't gotten into yet. I haven't had mine long enough. I've only had mine for about 10 years, but the flexibility is unbelievable if they're set up correctly. If they're not set up correctly, and I have a couple that aren't, they just don't work quite as well. But if they're set up to utilize this as a strategy, it's really an unbelievable tool.
I love that, Scott. Reaching financial freedom, just acquiring assets is not linear. We don't just wake up on the first of every year and go buy a year's worth of assets, collect the cash flow, and then next year do the same thing. Life happens. In 2020, we were at the peak of COVID. I was living out in California, and it was just nutty for all those people who live out in California or similar areas, New York. I looked at my wife. I said, "We just got to get out of here. This is crazy." So we ended up moving back to where my wife is from. We now live in Central Phoenix, and we bought a house as we were moving out here. And the lender said, "Hey, your DTI is a little off. You own quite a few assets. The underwriter wants you to pay off one of your assets." Now, most people would have been like, I can't just pay off an asset like that, and that would have tanked the deal. We said, "Sure, we'll take care of it. Can we have 5 days?" She said, "Yes." All we did was we took a policy loan from one of our policies. We paid off our rental, problem solved. Our DTI was brought down, and we closed on the house. Having access to capital is going to change everything for you guys. Why? Because life happens.
I do want to accentuate the idea of, it's not the right, accentuate, exclamation point, the idea of access to capital. I mean, my goodness, if you have access to capital, especially in the coming years, I see, I'm super excited to be investing. I'm glad you guys are a part of this and a part of Master Passive Income, because this is going to be so amazing to invest. If you have access to capital with this, let's say maybe you have a home equity line of credit or a business line of credit, if you have ability to borrow money, like you need access to the capital, not necessarily actually borrowing it at the time, but access to eventually be able to use that. One question I had, so on the dividend, and Scott brought this up, and Mike, tell me about this. So the dividend, let's say at year 20, it's basically $25,000. Is that literally we get a check every week, every month, every year? How does that work out?
So the way we design these policies is to have the dividend remain inside of the policy. All it does is it increases the performance inside of the policy. If at any time you want to change that and you want the dollars to go to your bank account instead, you just shoot myself or the life insurance company an email and you get a dividend payment. The dividend payment is taxable if it's delivered to you, but that's definitely an income strategy that some people have. I mean, let's go into our retirement years, age 65, we're 36 years in, the dividend payment is $66,000. Now that's going to slow down the efficiency of the policy. By the way, we put in 675,000 and we have almost 2.4 million in cash value, but maybe those numbers are sufficient for you and you're like, "Hey, I just want another additional revenue stream. Let's take those dividend payments."
That's terrific. Hey, Scott, so you said you have a couple, or you've experienced where it wasn't the best and it's not set up right. Would you mind sharing what we should watch out for or anything like that?
I think he left the call.
Did he? I don't
He got
see him.
bummed out that he got reminded that some of his policies aren't performing as desired.
Okay.
I can answer that though. So
Go ahead.
most advisors don't know how to overfund a policy. They don't know how to correctly use the PUA rider. And so what they're going to do is they're going to sell you a base policy. Base policies are great if you want a lot of death benefit. A base policy is the opposite of me driving that base down to 4746 in this example and keeping it at 30,000. We also lose all flexibility. If you don't have 30,000 and in this policy, all you have to do is pay the base. Well, if this was a base policy, your base is going to be 30,000. So that's the minimum and the maximum that you can pay. In the beginning, you would have no cash value. You'd see a goose egg in year one, a goose egg in year two. Year three, you put 90,000 in, you might have 15 or 20,000 in cash value. In exchange, you're going to have, $4 or $5, $6 million in death benefit, but that doesn't help us because the living benefit is minimized so much on the cash value side. So properly structuring these things is what makes it such a valuable tool for investors.
That's great. And honestly, guys, I actually heard about this strategy back in 2018. So 2017 or 18, I heard it back then. It definitely was not explained to me well. At the same time, I just kind of brushed it off. But then literally, I think it was like, I don't know, a couple months ago, I was talking with a really wealthy investor. He doesn't sell insurance. He does anything like it. But he told me, oh yeah, I use the infinite banking or my whole life, and basically the exact same strategy. And he was selling me on it. I was like, wow, really? He says, yes, I use it all the time. And all of my wealthy friends who are investors, they do the exact same thing. And I was thinking, man, that's if he, just a random person that I met, was telling me this, let me look into it more. And obviously got connected with Mike and being able to help understand this and walk this through. And so there's a couple more questions in here. Amber asks, so what's the risk with the rules changing 15, 20 years down the road to stop or reduce or ease the access to policy loans access? I'm not sure if I understand that question. Maybe Mike, you do?
Yeah, so with whole life insurance traditionally or historically, all changes to policies have only affected new policies. Everyone else has been grandfathered in. So I can't make a guarantee that's how it is moving forward, but that's how it's been historically.
Hopefully that helps. Ryan asked the question, what is the percentage rate to pay back when you borrow?
Great question. So the rate that the insurance company charges is variable. It changes once a year. Interest rates are higher, so rates have gone up. The borrow rate for a lot of our carriers is 5.7%. Now, some people then ask me, well, why would I borrow at 5.7% if, say, in year 7, I'm only making 5.1%? Great question. We need access to capital. So we're not going to be funding all these policies or funding all these premiums to then take all that money out and never pay it back. Just with the examples that have been shared on this call so far tonight, if we do this right, the capital is going to be inside the policy more often than not. When we need it, it's there at 5.7%. And on that previous question about the policy loans, like what if they change it? To add on that, it's a contractual obligation on the part of the life insurance company. I forget who asked that question, but it's a contractual obligation on the part of the life insurance company to provide you a policy loan. So if there's any future rule changes, you have a contract, a private contract between yourself and the insurance company to provide you those dollars. So those dollars are going to be there. And so you guys know the general funds inside of these life insurance companies by law have to be very, very large. They cannot go out and invest every dollar that they have inside of their organization. So these companies are very, very liquid. While the banks are completely over leveraged, insurance companies are going through this period very, very comfortably.
Talk to us about tax. It seems like this is after tax dollars. When do we get taxed? Like the dividends taxed and death benefit? Like talk to us about taxes on these.
So we can't utilize this as a retirement, like a traditional retirement account where we're putting pre-tax dollars in. We always pay the tax up front and then put the dollars in. If you use the policy loan function, again, all those dollars are utilized tax-free for your entire life. The only time you'd be taxed on accessing capital inside of a policy is if you're taking straight distributions from the cash value. Same as if you went down to the bank and took a debit of $10,000 out of your bank account. You can take or debit up to your basis or what you've put in income tax free. Anything above your basis is taxed at ordinary income rates. But if you're using policy loans, which is the strategy, then nothing will be taxed. The death benefit at the time of passing, that death benefit is delivered income tax free.
That's terrific. And Josh asked a couple questions. I'll answer the second one. And if you're new to investing, how many doors would you have under your belt before you would look into this type of investing in this policy? Honestly, what it comes down to is your risk tolerance and your goals, my opinion, and your financial ability. Can you actually do this? My goal was, number one, to be able to be successful and employed. I want to make sure I had cash flow coming in. And honestly, as I look at this, I'm like, wow, that's a lot of money. But now that I'm an investor, I'm blessed to be able to do that. Other people, it might have less doors and less, it just really depends on you and what you think is going to help you to keep getting to your goals. That's my suggestion. I know Michael might maybe have another answer, but also Josh, to follow that up, Josh had a question. When are you taking money out to invest? Year 5 or year 10? You kind of explained it, but go ahead and touch on that again, Mike.
Yeah, so on that second one first, anytime I have an opportunity that's far greater than what I'm going to pay, in this case 5.7%, I'm going to consider taking it. You'll obviously, here in the first 3 years, we're taking a negative hit. When you understand the value of whole life and the protection that it provides, I'm okay with that cost of insurance. Because if I were to pass away in year 1, it cost me $30,000 to get $993,000 tax-free to my wife and kids. So that to me doesn't matter. Doesn't mean I'm going to go put 30,000 in and go borrow 24,550 out. But if there's an opportunity that crosses my desk that's offering me 15, 25% rate of return, and I only have to pay 5.7 to access capital, I'm going to do that deal all day long. I forget the first question.
It was basically, how many doors should you have? Like, how far along in your investing? And like I said it's your goals and your risks, risk tolerances, and where you are, and then you can figure out that. But what do you think?
I see whole life insurance as the financial foundation for someone's life. So if you go acquire 5 doors and you're bringing, or let's say you acquire 4 doors and you're bringing in $250 a month, that's $1,000 a month. Let's say you leave the planet with 4 doors and you're married with 2 kids. Your wife gets $1,000 a month. That's all she gets, and any equity in those rentals. If you started with whole life insurance, the story ends much differently. But we're setting in place a foundation that can be built upon forever. So don't get hung up on this number right here, you guys. That number could be 7,500, 10,000, again, 150,000. The point is getting these dollars to begin working for you here and with an asset outside of whole life. And that's why if you dig into this strategy more, you might hear it called the and asset, because you can do this and another asset. You can build 2 assets at once with whole life insurance.
Yeah, so we're going to still take more questions, but I wanted to put it in the chat. If you want to set up a time, obviously Mike and I are connected. I'm more than likely, after RubeCon's over, right now I'm just so busy on RubeCon, but I'm really looking this for myself after RubeCon. But he's already talked to me about how we do our business. So he's definitely got everything lined out for us at Master Passive Income. So if you want to set up a call where he would literally walk you through, get everything, get you lined out to see if this is best for you, there's a link inside there. It's a connection, so you can go right to see. And we're going to put, I'm going to send this out in a replay later, to maybe tonight or tomorrow. But then also on this page there, I'm going to put it up there. So anytime you want to send, you want to go watch it again, learn this, this whole thing again, go there again, but set up a time with Mike. So it helped me. Like, he spent even more time with me walking me through it because I'm not that smart. So he was able to help me understand this, and my wife watched and said, oh, I get it. So anyways, yeah, so let's take a couple more questions. Justin said, so you can borrow from it at year 1 if you want to. There's no wait time to be able to borrow from it.
Now, within your first 30 days, those dollars are there. Now, the dividend gets paid out at the end of the first year. So you're going to see a slight difference in that dollar amount. In year 1, the dividend is $556. But the cash value, or most of that cash value, is going to be there within the first 30 days.
Awesome. So we have a couple more minutes. Anybody else have any other questions? I hope I didn't skip one. Oh, Shane, I scrolled back up. Saying, does the 5.7 interest rate go back into the insurance policy? So you're just paying yourself back with interest, or does it go to the insurance company?
So that's a huge misconception, Shane. I'm glad you brought that up because I would have forgot to mention it. A lot of people think that you pay interest back to yourself. That would be the case if you were using your own dollars. But because we're utilizing the insurance company's money, say you borrow 100 grand against your cash value from the insurance company, that's 100 grand that the insurance company either can't have in liquidity or they can't invest. And so they're going to charge you the interest rate of 5.7%. And it does go to them. The good news about that, obviously, is it keeps your policy from interrupting that compounding.
So NFL asks, and this kind of reminded me of Dave Ramsey. He talks about this type of stuff, but she asked, is this dividend payment because I overpaid on the premium? Where does it come from if it's not linked to the stock market?
So the dividend is based on the performance of the company. And what's key here, and this is another thing that you have to make sure you're getting into, is you have to buy a policy from a mutually owned whole life insurance company. And mutually owned means that you're essentially part owner within the life insurance company when you have a policy. And so you get to partake in the performance of that company. So sure, the insurance company goes out and invests a portion of your premium dollars into the bond market, into institutional quality real estate deals, but it's also the overall performance. So think about all those term policies that don't get paid out because insurance companies pay less than 1% of the time the death benefit on term policies because people don't die during the term. The actuarial scientists have figured this out. Well, when people stop paying those term policies, that's profit for the company. You as policy owners get a part of that in the form of a dividend.
Awesome. What other questions do you guys have? And while we're waiting for questions, Mike, is there anything else that we might have missed? Like any question we should ask, or actually maybe even any pitfalls that other people have fallen into? Maybe it could be something as simple as, they borrowed the money and went and bought a Ferrari, and then then it's just a liability instead of asset.
Yeah, you and I have kind of joked about that a little bit on our calls together. You can use the policy loans for whatever you want. The insurance company is never going to ask you what it's for. There's no underwriting period. It's essentially just like your money. Use it for whatever you want. I recommend that you utilize these policies for acquiring assets and not liabilities. There's people out there that'll say, you could go out and buy whatever you want because the compounding is there. You're going to be wealthy over time. That's just not the case. So I think the biggest pitfall is not managing a policy. Unlike a 401k or IRA, you do have access to your capital here, which is why Dave Ramsey doesn't like whole life. A majority of his target audience would not do well if they had access to their own money. That says a lot about his target audience. So it's just maintaining it. If you see a deal that you think works, leverage your policy. I think it's a great question.
Yeah, totally. And also, same here, like Dave Ramsey has great information. At least I brought up Dave Ramsey, nobody else did. But Dave Ramsey has great information for 75% of the population. But we're not speaking to 75% of the population. Like everyone here is we're the 25% that we actually can manage our money. We see that investing as well, we can do it well and be able to protect ourselves as well. So, is it Zynia? Sorry, I pronounced that wrong. I can't pronounce that. Is it Zania? Zaina. Yes. Sorry, Zaina. We will absolutely have this recording. I'll send it out. And then I will make sure that I'll put a page on my website that will be able to get this. So you guys can always go back to it, but I will email everybody out. Okay. A couple other questions. Is there a limit to the number of loans? Oh, let me ask this question first, because I actually kind of was thinking the same thing. Is there a way to transfer my term to whole life and actually I've already been putting it in a term. See, can I change it over to whole life?
So there are convertible term policies out there that we sell. Oftentimes this isn't enough death benefit for people because we're driving that down. So we'll stack a convertible term policy on top, which can be converted to a whole life policy. I've never seen a term policy owned by a client that was convertible. So more than likely not. And as you know, there's no cash value with term. So it would just be starting a whole life policy and either maintaining or discontinuing that term policy.
Awesome. So is there a limit to a number of loans? Like, let's say you have 3 different deals over 3 years and you keep pulling money out and they still have the money out, or is there a limit to the dollar or how many times and or amount? And will they literally let you pull out 100% of the cash value?
Yeah, you can borrow 95% of the cash value that you see in that cash value column, and you can take an unlimited number of loans. There's no cost to do a loan. You're not paying a point up front or anything. It's there for you when you need it.
Very cool. Ryan asks, would you recommend taking money out of your 401k to fund this?
Would I recommend it or did I do it? No, I wouldn't recommend it because I can't do that as an advisor. You have to understand the risks of, right now we're in a down market, the risk of cashing out in a down market, and just weigh those with your why. Something I can do is share my story and why I did it. Our retirement accounts did not align with our whys. For my wife to have to wait till she's 59 and a half, and for me, I was 50 when, or I could have accessed my pension when I was 50. I didn't want to wait that long. And this right here aligned with my why because it aligns with real estate.
And I'll say, definitely add in, I literally cashed out my entire 401k, IRA, like all that sort of stuff, all my retirement, literally cashed out because of investing in real estate. So I bought real estate with it. So not necessarily this, doing something like this, but man, honestly, in my opinion, the 401k, the rich people made that up to take money from us. I'll be completely honest. That's my opinion. They make money on us, hand over fist, put it back. I put it back into my own businesses. That's what I do. So that's my perspective. And so if, you definitely need to have your own vision, goals, and do what's best for you. But like Mike and I were just telling you what we have done. Yennefer, you have a question. Go ahead.
Yes, so is this example here with starting with a person that's just paying plain premiums that didn't fund this like with a chunk of money? Because they say I decide to start this, right? And I don't have $20,000-$30,000 in my saved up, right? Or in my 401k to transfer, and I'm just starting to pay premiums. How do I accumulate? How much money would I have, and when would I have access to that kind of money? Like how much would I have?
Yeah, so we put in what makes sense for you. If you do have a large sum of capital in the beginning, but that's just like a one-time thing, so you sold an asset, then we can do a front load strategy. Or instead of 30,000 in year one, maybe it's 100,000. And again, these numbers are just examples, but we put 100,000 in year one and we put 15,000 in year two and onward. So we can be flexible in those first few years. Actually, we can add more and then do less moving forward. Does that answer your question?
But let's say I don't have any to put it, like I'm just gonna start with a policy and I'm starting out and I'm just gonna put whatever monthly fee that whatever monthly premium you say I have to pay, right? Let's say I want to get insured for 50,000 to start with, just because I want to have something for my family, and I want to start with that, and I don't have anything, I'm just gonna pay my premiums. When would I have access to capital?
So if you're paying premiums into a whole life policy, you have access to the capital within 30 days. And whatever it is that you can afford, we build a policy around that. Now, the downside is we have to figure out what that annual premium is going to be in the beginning. We can't increase that over time, but we could arguably open up a second whole life policy when your financial situation changes in the future. We could do like a one pay where you put in, say, $50,000 one time and never make another premium payment. But then we're gonna have a taxable policy, which is what we don't want.
Got it. Thanks.
And again, you only have to commit to the annual premium for 8 years.
So hopefully everybody heard that again. Say that one more time, Mike.
So you only have, so I always build these policies with a long pay strategy because we don't know what the future holds. But there's flexibility. If we design it this way, you only have to commit to 8 years. Paying the premium for 8 years. After that, you can reduce pay up the policy. These all turn into goose eggs. You can never put another future premium dollar in, but you can still leverage the cash value. It still grows each and every year, as does the death benefit, just no new premium dollars go in. So that's a strategy that, even a lot of wealthy people use. Again, not every dollar has to go into whole life, but wealthy people tend to pump in a lot of money up front and then they can just turn it off in the future.
That's awesome. And so we're going to be wrapping up in just a second. But again, I put that link in there, masterpassiveincome.com/Axiom. And that will, like I said, Mike and I have talked about investing. This is the reason why I brought Mike. There's so many insurance agents out there. In fact, I have a couple friends that are really, they're insurance agents, but they're not real estate investors. Mike understands both. And I've talked to him and I'm working with him on doing this for me. So just presenting to you guys, if this works out for you and your family and you're investing, then fantastic. So he would love to help you and customize it for you. Like he said, all these are just numbers, examples. It could be lower, it could be more. Let's say it's, $10,000 as opposed to 30. He'll help you to see what it's like. For me, I was talking to my wife and saying, this looks pretty amazing. And she liked the death benefit because if you die, who's going to make money? I'm like, well, we have properties that'll keep making us money, but there's an extra $2-3 million on that. So last question, Evan said, would you keep your emergency funds separate from your whole life, or would you keep all of your spare dollars with your whole life policy?
I love that, man. So the stack that I was talking about can live inside your whole life policy. There's no point in having dollars in your ecosystem with zero velocity to them. And so if we just store them inside of the policy, we're earning that 4 to 5% rate of return. That's all it's doing. And it's buying us more and more death benefit as well.
You could always access it. Obviously, we have.
You can always
that.
access it.
Yep.
Yep. The money is going to be in your account. Anywhere from 2 to 10 days, the money gets ACH transferred into your checking account and it's there for you. So, we don't have $0 in our bank account because we have monthly expenses, but anything beyond monthly expenses lives inside of our whole life policy. Guys, the link that I believe Dustin shared was a link to our masterclass. I highly encourage you guys taking that 25 or 30-minute masterclass where I do a deeper dive into whole life insurance, discuss policy loans. We discuss strategy and tactics on how to implement this with real estate. I strongly believe that having just one whole life policy in your family will change things for you.
So I did put, Mike, go ahead and stop sharing. I'll share the screen that I have for this. So I will also, in the email that I send out with the follow-up, so you can watch the video again. I know I had to watch it a couple times, but here's the video. Or here's the page that we have. And obviously I'm working with them personally because this is what I do with my business. But our video that we're recording right now is going to go there, and then you can fill out and get access to the masterclass, but then also work with Mike directly. He and his wife are awesome, and they will definitely help you in all this and just see if it fits for you. My wife and I are still going through it at the same time. We haven't done it yet, be completely honest. We haven't done it yet, but we can make sure that you have as much information as possible on what you could potentially do with all your investing. So after the masterclass, well, Mike, if they sign up for the masterclass or on that page, is that where they can connect with you and get started on, talking about customizing something for them?
Yeah. So after you sign up for the masterclass, there's going to be like a congrats page. On that page, there should be a link to schedule an intro call with myself where we can dig in and talk specifics. Highly recommend that you take the masterclass. Again, it's 25 or 30 minutes. Take that before we hop on a call. So you can ask really, really good questions. And from there, we can put together a plan. This isn't, 1 or 2 emails back and forth like you're getting a policy on your pickup truck. There's a little bit of hand holding in the beginning. This is very, very hands-on. Process takes anywhere from, call it 7 to 30 days. But we get something that fits your specific situation.
So cool. Well, I hope this helps at least open your eyes to other things that honestly, what I think like the wealthy are doing. Like we just usually just do what we're told, go get a job and then work there for 40, 50 years and retire and live off of what we managed to save our entire time of working a just over broke job. And now there are so many other options. I mean, even HELOC or home equity line of credit, but this is something that could be very, very beneficial. Hopefully you guys, at least take advantage of, talk with Mike and see if he can customize something that would fit you. But yeah, no, I really appreciate every single one. Mike, thank you so much for coming on. This is fantastic. So we'll go ahead and Mike, unless there's anything else, we'll go ahead and sign off.
No, that's it, guys. Thanks for showing up and stay liquid. It's going to be a wild ride the next 24 months. So have lots of fun with it.
Awesome, guys. Hey, thank you so much for being here. And thanks for being a part of Master Passive Income, everybody. See ya.
See you guys.